Hi everyone, I'm Surushka from Regan van Roy, and today I'll be unpacking our newsletter on GAAR. Now, GAAR stands for General Anti-Avoidance Rules, and such rules were introduced to the South African Income Tax Act in 2006 and came into operation on 2nd November 2006. GAAR applies to any arrangement which could be a transaction, operation, or agreement, including all steps therein. And such agreement was entered into after the 2nd of November 2006. So the GAAR rules are found in Section 80A to 80L of the South African Income Tax Act. In summary, Section 80A defines what an impermissible tax avoidance arrangement is, which I'll touch on in a moment. Section 80B lays out the potential actions that the Commissioner may take with respect to such avoidance arrangements. Section 80C to 80G expands on the requirements of an impermissible tax avoidance arrangement as set out in Section 80A. And Section 80H to 80L provide general procedures and definitions. So when does GAAR actually apply? So taxpayers are allowed to arrange tax affairs in the most optimal manner, but where arrangements are entered into for the sole purpose of obtaining a tax benefit, which could be an avoidance, postponement, or reduction of any tax liability in South Africa, and such arrangement either is carried out by means or in a manner that would not normally be employed in the course of business. Such arrangement lacks commercial substance. For example, there are indications of round-trip financing, or a tax-indifferent party, or the arrangement creates rights or obligations that would not normally be created between persons dealing at arm's length. For example, there's an additional deduction that is claimed as a result of such arrangement, or such arrangement would result in the misuse or abuse of the provisions of the Act. Where either one of those are present, the arrangement may be classified as an impermissible tax avoidance arrangement, and such taxpayer will then be at the risk of the Commissioner challenging such arrangement and potentially taking certain actions. The most common action enforced by the Commissioner is that the Commissioner will treat the impermissible avoidance arrangement as if it did not exist, or in such a manner that the Commissioner deems appropriate. So this means that the tax liability linked to such impermissible avoidance arrangement will be calculated in a manner that is not normally employed, that is normally employed in business or between arm's length parties. Other remedies include the Commissioner disregarding, combining, or recharacterizing any steps or parts of the arrangement, disregarding any tax-indifferent party, or deeming persons who are connected persons to be one and the same person for the purpose of determining the tax treatment of any amount. And finally, reallocating or recharacterizing gross income, expenditure, or a receipt or accrual of a capital nature. So in summary, for the GAAR rules to apply, there must first be an arrangement in which a tax benefit is derived. Secondly, such arrangements' sole or main purpose must be to obtain a tax benefit. And thirdly, the arrangement must be classified as an impermissible tax avoidance arrangement by either having an abnormal characteristic, lack of commercial substance, or round-trip financing. The last important point to remember is that an avoidance arrangement is presumed to be entered in or carried out for the sole or main purpose of obtaining a tax benefit, and the burden of proof lies on the taxpayer to prove otherwise. So that brings us to the end of this video. If you'd like to discuss this in more detail, please do contact us. Thanks for listening.